The worlds of Wall Street and crypto are in the middle of this massive clash over one huge idea: tokenizing stocks. But what does that even mean? When you buy a token that says you own a piece of Apple, what do you actually have in your hands? A real share? Or just a reflection? Well, the answer is it's pretty complicated.
So let's get right into it. Here's what we're going to cover. We're going to look at the two very different paths being carved out by giants like Robinhood and Kraken. Then we'll dig into the real financial reason this is all happening. And finally, we'll zoom out and see what this means for a future where literally every asset might live on the blockchain.
All right, so the race is officially on. You've got traditional players like Robinhood rolling out stock tokens over in Europe, and then you have crypto-native exchanges like Kraken launching their own versions. Now, on the surface, they look kind of the same, right? But what's going on under the hood couldn't be more different.
So let's ask the million-dollar question. You click buy. What did you just get? Do you now have a share with voting rights? Is it a token you can move to your own wallet and do whatever you want with? Or is it something else entirely? Believe it or not, the answer completely changes depending on where you clicked that buy button.
Okay, first up, let's check out Robinhood's approach. Now, remember, they're coming from the world of traditional finance. So for them, priority number one isn't crypto-style freedom. It's about playing by the rules and making absolutely sure the regulators are happy. To really get what they're doing, you have to understand this thing called a contract for difference, or a CFD. This isn't the stock, not even close. It's basically a bet between you and your broker on which way the stock's price is going to go. And here's the absolute key. You never, ever actually own the asset itself. And that's exactly what Robinhood's stock token is. It's a fully regulated CFD. It perfectly mirrors the price of a real US stock, but it's not the real thing. It's this structure, this derivative, that lets them operate legally under Europe's super strict MiFID II securities license. So what does this model look like in practice? Well, it's a completely walled garden. You get a contract, not a share, which means no voting rights. The token can never, ever leave Robinhood's system. And yeah, they use the Arbitrum blockchain, but it's really just for their own internal bookkeeping. It's a system built from the ground up for regulatory safety, not for crypto freedom. Now let's flip the coin and look at the other side. Here you have the crypto-native exchanges, like Kraken. And they are building this thing from a totally different philosophical starting point. It's all about true ownership, decentralization, and open access. And this is the fundamental difference right here. Their product isn't some reflection in a mirror. It's designed to be a direct map to the real asset. Every single token is supposed to be a true one-to-one representation of a real stock, fully tradable on a public blockchain like Solana. This model, it has everything crypto people love. You get a token that's actually backed by a real share. You get paid dividends, and most importantly, you can pull it out into your own wallet and have total control. So what's the catch? Well, this open frontier is also a bit of a regulatory Wild West, and that comes with some serious compliance risks. So here it is, the two worlds side by side. You've got Robinhood's mirror, safe, regulated, but totally closed off. And then you have Kraken's map, a true asset-backed token that gives you freedom, but it's sitting in a legal gray area. It really is a choice between a safe, walled garden and an open, but maybe treacherous frontier. This all begs a really big question, right? Why would a company like Robinhood go through all this trouble to create a crypto-like product if it's just a closed-off derivative? Well, the answer, as it so often is all about the business model. To really get the motivation here, we have to talk about how Robinhood actually makes its money. It's a practice called payment for order flow, or PFOS. See, instead of charging you commissions, they sell your trade orders to giant market makers, who then pay them a tiny little rebate for sending the business their way. And here, this is the secret sauce. According to an SEC paper, those rebates Robinhood gets are wildly different depending on what you're trading. For a regular stock trade, they might get less than 1 basis point. For options, okay, it's about 10 times more. But for a crypto trade, it's jaw-dropping 55 basis points. Let's just put a number on that to make it real. It means that dollar for dollar, a crypto trade is around 45 times more profitable for Robinhood than a simple stock trade. I mean, just let that sink in. The financial incentive to push all trading into a crypto-style model is just unbelievably huge. And here is the reason why. Payment for order flow on stocks. It's either banned or super heavily regulated and requires tons of disclosure in many parts of the world, including Europe. But PFO for crypto? It's pretty much the Wild West, globally unregulated. This is the real prize. Bring all assets into this model to take advantage of this much more lucrative, unregulated system.
So let's zoom out for a second, because this isn't just about Robinhood's profits. This whole competition between the mirror and the map is really the first big battle and a war for the future of the entire financial system. I mean, the potential here is just staggering. Imagine 24/7 global markets for every single asset. Imagine trades that settle instantly, which would completely eliminate the delays that caused all those problems during the GameStop frenzy. This is the world the map approach is built for, and it's a world the mirror approach wants to keep inside its walls while still getting all the benefits. And that's the end game. It's about completely rebuilding the plumbing of finance to be faster and way more accessible. And for the platforms that get to control it, it's also about capturing those incredibly profitable business models from the crypto world. The race to bring every asset on chain has definitely begun.
And all of this leaves us with one last really fascinating question. As the traditional gatekeepers like the New York Stock Exchange start to lose their monopoly on time and place, who actually decides what something is worth? A whole new battle for control, over price, over liquidity, and over the future of capital itself is just getting started.